And that spike in oil prices is throwing yet another curveball at investors just in time for this week's Federal Reserve meeting. Mike Santoli has more.
After a bitter setback in August, the stock market finds itself in something of a sweet spot. The question now is how long the market can stay there after an oil price spike and with a crucial Fed meeting just ahead. Several key market variables fell to extremes last month. Treasury yields fell to three-year lows. Economic expectations sank in anticipation of a possible recession. Investor sentiment turned quite pessimistic given the S&P 500 never fell more than 6% from a record high. In recent weeks, though, data on jobs and retail sales have calmed recession worries and sparked a powerful rise in Treasury yields from the low of 1.44% to above 1.8%. Yet they were above 2% the last time the S&P 500 was this close to a record in July. And rates are not high enough yet to pinch economic activity or undermine equity valuations. The firmer economic readings are a comfort to investors, yet are not so hot as to jeopardize the expected quarter-point Fed rate cut later this week. The 6% rebound in stocks in recent weeks has brightened investor spirits and prompted some fresh inflows into equity funds, but sentiment is far from turning complacent or over-optimistic just yet. Even oil prices, surging after the weekend attacks on Saudi infrastructure, are rising from benign levels and aren't even back to their springtime highs. For sure, the geopolitical implications are an unknown risk. The trade war simmers in the background, and the past two sharp pullbacks in stocks also occurred with the S&P near a high in a Fed meeting week. That was back in May and July. Still, for now, the market backdrop has improved in most respects without yet being too good to be true. For Nightly Business Report, I'm Mike Santoli.